Hey everybody, this is Brent from Wolf on Wall Street Trade with a market update for the week ending April 17th, 2020. This is going to be kind of a short video. Members, you know everything that I know, but I do want to make a very specific point, and that's kind of what I'm going to do with this video. So a lot of economic data out this week, all really ugly. This is initial claims, 5.25 million new initial claims. So that's about 22 million people who filed for unemployment in the last month. Now, for some perspective, this is the financial crisis over here. So we've just blown past that. All the job gains that have been added since the financial crisis are gone in the last 4 weeks. But hey, look at this. The S&P is up 3% on the week. Yeah, there's a little disconnect between what's going on the ground and what's going on in the market. But this is pretty common stuff. Bear market rallies, they are the most spectacular things you'll ever see. That's why they call them suckers rally, because people get sucked back into them. They look real, they feel real, they're just immense, and people think a new bull market started. So this is the Dow Jones Industrial Average, and I have a yellow moving average here. It's a 50-day simple and a 200-day simple. So what I'm going to do is just back to 1929. Look at the Dow now. This is 1929. You can see the months down here, and this is the crash of 29, the initial crash. And this is the first counter trend rally. I mean, it's very similar to what we have right now. Two little legs over here. There's that 50-day moving average. There's the 200-day moving average. I'm just going to walk you forward and show you what happened here, because this was one of the most spectacular bear market rallies I think you'll ever see. That's the counter trend rally, the bear market rally, 50% gain in 5 months. And then I'll show you what this all looked like in the big picture. So here's the crash. Here is the counter trend rally of about 50%, and then this is just a bear market during a depression, which meant it lost about 90% of its value. This is what it looked like about 3 weeks into that rally. Now keep in mind, it went on for another 4 months and added up to 50%, but this is what it looked like. Check out the moving averages, and let's go back to present day. And here we are at present day. So my point is not really, oh look, the market's going to crash next week or anything like that. And my point is that this is very typical of a bear market rally and what they look like. And here we are looking at a monthly chart of the S&P 500. So this is when the tech bubble exploded, and this is a bear market. This is the financial crisis, 2007, 2008. So there's the bear market, and this is where we are now. And the idea among a lot of people is that we have basically discounted what is going to be the worst recession since the Great Depression that I just showed you, and what may actually be a depression, that we've discounted all that in 8 simple weeks. Personally, I don't. That doesn't mean I know where it's going a year from now, but I absolutely do not believe that we're done. This is a V-shaped bottom, and it's done. So here's the S&P 500, right up to its 50-day moving average. And the NASDAQ 100, it's actually up just a little bit over 1% year to date, if you can believe that. And then we have small caps, which were the worst on the week. They actually closed the week down a little bit. So you have NASDAQ 100. This is where all the mega cap stocks are, up over 7%. You have the S&P 500 up 3% on the week. Almost all that came on Friday. And then you have small caps down a little over 1% on the week. So we're just going to review real quick. This is a 30-minute chart. You can see it up here, just so we have some context to put all this in. So we don't need to go through all the sectors and all the trend lines and everything. It's just important to realize that we had the kind of reopening the economy trade here, driven by a short squeeze. And this first week over here was driven by the cyclicals, the growth sensitive stocks, but the mega caps, or the secular growers, were not performing well. And then that trend completely reversed this past week, where it was the growth sensitive cyclicals that underperformed, small caps underperformed, and as you saw with NASDAQ 100, those big heavy weighted FANG stocks, the mega caps, outperformed significantly. It's very, very similar to what happened before this crash. So if I come back just a little bit further into January and February of 2020. Remember, we got a warning sign here. There was a lot of warning signs over here. Crude oil and copper and yields all plunging, but the market went to make new highs. And pretty much all of this from basically January was driven by about 6 stocks, all these mega caps, okay? So the Fed was doing their QE, pumping hundreds of billions of dollars into the market. That was flowing into these mega cap stocks. So that is the theme that was happening this past week. And during this, while this was happening, we were seeing a lot of the cyclical sectors like industrials and transports were struggling over here. The growth sensitive stuff wasn't doing well. That's the same theme that happened this past week. If we look at price action of the S&P 500, this is a 5-minute chart. This is the last couple weeks. You see there's really nothing wrong with the price action here. Members, you know what's going on with small caps. I've covered that. And the cyclical sectors that we talked about. And then the thing that's most important to me is market signals. So that is the big key this week, market signal. What were we screaming about in January, from mid-January all the way through February, screaming about in every video I did back then? It was market signal. It was what the commodity market, the bond market, and the currency markets were saying, all of them saying together versus what the stock market was ignoring. So the last week I've been building a short position, not really a trade, more of a position like I was building back here in small caps. One of the reasons why I started it the week prior was just the risk reward to me. I liked it a lot up here. If I can sell short around this area, I like it. The reason why is because I think there's a lot of overhead supply. I'll show you what that means. So this is a 2-day chart of IWM. You can see resistance here in this level. Let's just call it 126 or so. Finally breaks out with the global growth narrative over here. And when it sells off in December of 2018, finds support there. So former resistance became support when it was tested, and then on this sell-off, it broke down. So this is the idea of overhead supply. A lot of people bought over here. They bought over here. They rode it up. They had a gain maybe, and then they went through this horrible situation where the market just sold off, and they probably had a lot of sleepless nights and said, oh my gosh, if the market would just come back up so I can get out, at a smaller loss, I will sell it. That creates a situation called overhead supply or resistance, where people who had bought over this, let's just say this trend line around 126, are now at less of a loss and they have an opportunity to sell. So as of last week, that's the reason I started a short position in this area. I said I only like it because of the risk reward right now. I don't like it because of market signal. So that started to change this past week. Why did that change? 1, small caps showing relative weakness. 2, the cyclical sectors, the growth sensitive sectors, material, energy, financials, industrials, started showing weakness this past week. Now what happened on Monday? The banks started to report earnings. So here's the KBW Bank Index. This is a 5-minute chart. This is the short squeeze rally I was telling you about, and leading the market up to the upside, small caps outperforming. So this is Monday here, JPM reports, and the first thing that we saw was bearish price action Monday after they reported. I increased my short position in small caps Monday because of that, and then we saw just bearish price action in the banks the rest of the week until Friday, where we got this big move up, and that was on that remdesivir information that came out Thursday night after the close. The broader point I'm trying to make is all of those growth-sensitive sectors, cyclical sectors, underperformed on the week. So that is market signal coming from S&P sector performance and coming from small caps relative performance versus the rest of the market. But that wasn't even the big thing. The big thing was this week we also had, coming into the week, OPEC had their virtual meeting. They did their supply cut and all that, and we were looking at crude oil. Let me show you with USO. So this is a 15-minute chart, USO for crude oil. There was a huge short squeeze. It had its best week ever over here. And then as it came over here, this is 2 weeks ago, it came over here and started a bullish small consolidation. I'm going to zoom into this area right here. So here it is, the big short squeeze in crude, best week ever for crude. Big bull flag, moves up, another bull flag over here. Price action is in this bull flag. And then what we saw this week was the price action, actually last week, the end of last week, was the price action was no longer consistent with a bull flag. When you have a bull flag or a bear flag, price action should really calm down a lot. It should be pretty quiet. And what we started seeing was these huge swings around this channel, right? And then crude actually had, I think that last Friday, right before we came into this past week, it was up at 1.6%, then down 12% in the same day. It was the most volatile day for crude oil ever. And what I said to my members is there is no way that this is a bull flag. Even though it looks like it on this scale, there's too much price volatility in it. That is not how flags, bull flags or bear flags, act. We got this whole OPEC cut, all that stuff the market was looking for, it got. And what happened? Crude oil sold off 20%. If we look at the May futures contract, here is that little area of consolidation. This is this past week. That is more than a 20% decline to a new 18-year low in crude oil. 20% decline while the broader market was up on the week. So here's the S&P 500's all-time record high. What did we see all through this area? What were the market signals that were screaming trouble ahead? Here's USO in white. It was a 20% drop in crude oil while the market just ignored it and said, oh, happy days are here. The Fed's got our back. The Fed's pumping money into the market. It's nothing to worry about. Let me show you another way The red and green candlesticks are S&P futures. The white line is the crude oil futures contract. And here's the date. So this is October to December of 2019 and into 2020. So we'll just walk this forward real quick. And you can see they're both moving up. They're both risk assets. And here is where we started to get the first sign of trouble in about mid-January. See crude diverging from the S&P 500. It's sending a market signal at that point, but stocks ignore it. Stock investors ignore it. And we get nothing but a 3% pullback over here. That's it. That's it for coronavirus. That's all the risk the market sees. But look at crude oil. It's down 20%. Go and rally to all-time new highs. And by the time crude oil drops again, the warning's there. It's too late. There's the crash. So this is the point I'm getting at, is the last couple of weeks, crude has been kind of all over the place, with these OPEC meetings coming up and getting canceled and all that. But you can see, again, this week, 20% crash in crude. What I always say is, look, when the market sends you a signal like this, it's sending you a message. You can ignore it if you want to, but a 20% drop in crude is no small pullback. It's no small thing. That is a big message coming from commodities. And what's really interesting is that at the same time, we see all these mega caps leading to the upside. We've got the Fed doing the same thing, pumping money into the market. That was exactly what was happening at all-time record highs. And in S&P sectors this week, where do we see the weakness? In cyclicals. So materials, energy, financials, banks, industrials, transport, stuff like that. And where was the strength? It was in the mega cap heavy sectors. So technology, communications, and consumer discretionary. So I'm not going to say it's as bad as it was back then in February, when we were really screaming, because other things were everything was sending a market signal that a crash was coming. Copper was, treasury yields were, currencies were. So the other thing that did move this week were treasury yields. So this is the S&P 500. And this is the 30-year yield. So this is about 2 weeks ago when small caps were starting to lead to the downside. Treasury yields were starting to decline as well. And this is over the weekend when New York, their infection rate started to bend the curve. Curve started to come down. And we started this reopen the U.S. trade. And as we get into the week here, let me show you what happened. Crude started selling off really bad on Tuesday. And what I said to members was, I'm surprised that yields haven't yet. And then on Wednesday, yields did what I thought they would do, and they followed crude lower because they are both sending a negative economic macro signal. And that basically carried on into the end of the week. We did see this weird move. It was actually the Fed tapered their bond purchases again from initially, I think it was 75 billion down to 60 billion, down to 50 billion. Down to 25 billion, and on Friday they tapered them, I think, down to 15 billion. The bond market hadn't reacted to any of those tapers, but this was a taper tantrum. This has nothing to do with the economic or macro signal. This is the bond market freaking out that the Fed is basically tapering off all those bond purchases. So I changed this to USO for crude oil. So what you have is that sell-off here in crude oil, and you have the bond market following it. So they're both sending that same signal. Now, it could be worse. There are a few other things like currencies we've been looking at. This is the start of one of those ugly macroeconomic signals that we're seeing from commodities and rates. At the same time, investors in stocks feel like they are bulletproof and we're going to the moon again. So that's the kind of scenario I do want to sell short into, not just as a trade, but I want to build a position like I was doing over here. So we're getting a message from the market. Let's pay attention to that message. So that'll do it. If you enjoyed the video, please give it a thumbs up and feel free to leave questions or comments in the question section. Also, check out the website. I do post free posts. Last weekend, I didn't do a video, but I did have a weekend update out. I made it free, so you could check that out. And if you want to subscribe and be a member, it's about $50 a month, which is not a lot for the kind of content you get. 12-hour days on my end here. And members, I will see you on Monday unless something happens with futures Sunday night, which it has been recently. Then I'll have a update out Sunday night, a brief. Everybody, stay safe. Have a fantastic weekend. Thanks for listening. Take care.